Ever had a stop that gets hit right before your trade takes off? Today, I'll show you how the pros use volatility with the ATR trailing stop to avoid getting shaken out. The ATR, the average true range, was actually developed by J. Wells Wilder in his book in 1978, and then expounded on with the ATR trailing stop by Sylvian Vervoot a few years later. It's been working for at least 50 years. An ATR measures how much a stock moves in a day. A trailing stop based on the ATR moves with the market. It gives trades breathing room in volatile markets and keeps you tighter in calmer ones. Now, keep in mind, I use some moving averages. Don't get me wrong. I'll use a 50. I'll use a 20. I'll use a 200 and a 9. Guess what? That is what the pros use. They don't use other ones. Those are just used to sell books or classes on multiple sites I've seen. Those are the ones the pros use. So we will go into moving averages in a different video. Now, what do we show with the average true range trailing stop? You see, you could use the 50, but a lot of times it gets you out first. Now, you might say, yeah, but it gets out too early, because it does react a little better. But go and look at it as an algorithm. Now, I'll use it sometimes on a daily, but mainly I use it in multiple time frames intraday. But I'll just show you how it works. Make it like an algorithm. I talk about this all the time on our site. Basically, it keeps you in a move longer. Doesn't get you stopped out as much. I'll show you what we're talking about. So here, you're buying, you're getting stopped, you're getting back in, you're getting stopped. What's happening? You're making a ton here. You get stopped, you're getting back in, you lose a teeny amount. You get in here, you're in for the ride. You get out here, you get back in. Do it like an algorithm, automatically. You get out here, you get back in here. You get out here, you get back in here, and you got stopped. Boy, you lost just a little. Right here, you probably lost 200 points. What'd you make here? You made about 3,000. It keeps you in a trend longer. Now, a lot of times I'll combine this intraday with a 9-period moving average, a 9 EMA, and let me show you why. So the ATR trailing stop definitely will keep you in a trend. In a tight market, a less volatile market, it will ride the price a lot closer. I just want you to realize that. So let's go into a 5-minute chart of the NASDAQ, and I'll show you what we're talking about. So you see in here what I'm combining. Now, you might ask, but the ATR trailing stop's so far away. That's exactly why I'm using a 9. Why? Because if the true range goes higher, then the average true range is going to widen. The average true range is taking a multiplier, and I'm using 2.9. That's just worked for decades. And I'm taking times a number of bars. So I'm taking 9. I'm taking a 9 period and 2.9. So in that 9 period, if you get a tremendous amount of a range, the ATR trailing stop's going to widen. When that happens, you got to use a 9. So as you see, this gets you stopped up here. So a lot earlier. My goodness, that's 80 points. So I'm just telling you right now, it gets you out faster. So if it gets too far away, I got to use a 9. And that's just how we combine it in here. So let me show you this, because I think it's fascinating. Go over here and look at the markets today. And what do you see on a 5-minute? Well, you see it got too far, but you rode the trend. Now, how about on a 15-minute? Well, I bet it's still bullish. It sure is. Now, you might have gotten stopped here, but still, that's a heck of a move. In the long run, though, it's still in an uptrend. How about an hourly chart? Well, you'll see. It's pretty far away from both, but you didn't get stopped out yet. So on Friday, on Wednesday, went down, you rode the trend. You would have gotten stopped here. You would have gotten back here and rode the trend. And then it gets too far from the 9. You got to get yourself stopped out using the moving average. But it works pretty well. Let's go take a really trending stock. How about Microsoft? What do you notice? That's an amazing thing. We were short Microsoft. So what happened? Yeah, if you sort of bought here, you would have gotten stopped here. You would have lost 2 points. If you shorted here, that's a look on the right, 523. So if you shorted here, you wrote it all the way down. And then when it got too far from the ATR trailing stop, you probably got stopped here. Now you might say, well, what happens if you got stopped there? Well, you would have gotten right back in. Would have gotten right back in. To me, the 9 leads to a lot more fake outs. But if it gets way too far away, yeah, then I'll use the 9. Here, it just wasn't that far away. And then you wrote it all the way down until here. That's about 20 points. Fascinating to see. Now, you might ask, well, how about on Friday? How about a 5-minute? What did a 5-minute show you? Well, same thing. It got too far away here. Let's say you're long here. Well, you got to use something else because look how wide that ATR trailing stop is away from it. So you would have gotten out here, 509.50. That's where we actually did some put flies under the market. Now, you might say, well, it went here. Why didn't you short again? It just was at support. You also have to combine my other video on support and resistance. So here you might say, well, now I want to buy them bullish. Well, you would have gotten out here. Literally, you lost 30 cents. So when you're right, you made about $3.50. When you're wrong, you lost 30 cents. That's how I use the ATR trailing stop. I like using it on a 1-minute, a 5-minute, and a 15 and an hourly intraday. Hope you like this. Take care.